It's Sunday, the 28th of October 2018. It's been reporting season for the ASX gold stocks in the last couple of weeks, so I thought I'd do a bit of a run through on some of the more interesting results and also discuss some of the broader trends in the international gold stock market. One of the main ones that I know a lot of people were following was the Resolute Gold quarterly report. I've got a copy of it here. It was pretty weak numbers came out. I know a lot of people expected weak numbers, and they'd flagged that they had a roaster shut for 40 days, but they still missed. I think even the sort of the guidance that they haven't got a guidance for the quarter, but they missed analyst expectations. Costs were quite high, 1,560 Australian. Cash burn was extremely high. I think about $80 to $90 million cash burn. It is a heavy investment period for them at Syama in Mali. They're obviously going underground there, but their trend is not great in the short term, and I think they've probably got another poor quarter ahead of them, and whether the market's really adjusted for that, I'm not sure. The stock has been under a lot of pressure from short sellers. I've been out of it since I think I sold some in the April quarterly, and then again just before the July quarterly, and I've been out of it since then. And I thought there was better plays at the moment. They got these high cost numbers. It's largely expected that they're going to deliver these numbers, but I guess a question might be asked whether they've got enough cash to sustain themselves. I did listen to the quarterly report, their quarterly conference call, and they were talking about they still had enough cash to make it, and they about 70 to 80% through the major investment at Syama. So you'd expect their production to pick up towards 70,000 ounces in the December quarter, and then they've still got a bit of debt to draw down, and I think they'll probably be okay. But there's probably less wiggle room than some people would have liked, and that's concerning some, and they're selling the stock. But it's been under pressure, and I've just stayed out of it. It's a good long-term play. I think Syama will be a good mine and will have high margins when all the investment's done. But you just need to make sure that they've haven't underestimated some of the costs associated with this development, and they've got enough cash, because a capital raising in this environment wouldn't be a good move. They probably still have access to debt, so a capital raising is probably unlikely. But I was going to wait till this quarter came out, and then when it came out, the stock fell 8 or 9% on Tuesday on the release. So obviously that weak number wasn't really factored in. I know a lot of people expect these things to be factored in, and everyone's knowing this, but it just happens that when a number comes out where it's very high cost, very high cash burn, despite the fact that it's an investment, that cash is being burned to invest in the future growth of the company. The market doesn't always see it like that. Anyway, that's what I think of Resolute, and I'm still sticking on the sidelines there. And I think there's, on a risk reward basis, it's probably not quite there yet. And I'd want to see some signs that they're still going to meet their production guidance for this year. Perseus, I think, is probably a better play and that's where I moved my money from Resolute into Perseus. And that sort of, when it was in this 35 to 37 range, I thought it was very good value. Their quarterly was a bit more consistent, I think. They're starting to pay down debt. They're in sort of a different phase, I guess. They're past that heavy investment phase. Reasonably good operating costs at the moment. Paying down debt, building a bit of cash. For the next 6 months, I think they're in quite a good position, and I think the stock is, probably going to rally with the gold price, which I think is in a good position at the moment. So I think Perseus is probably a better way to play gold price strength than Resolute, and that's where I've sort of moved in the short term. I think this is a good little chart. I think they've got the units wrong on this axis here. This is actually US dollars, but they're paying down debt, building a bit of cash, as I said. So I'm happier being in Perseus than in Resolute. Their quarterly was okay, and I think they do have to. They had a lot of heavy rainfall at their mines, and that may have affected production a bit. But I think in general they've sort of guided to fairly low numbers in that, and they've probably got a decent chance of beating those numbers, especially if the Sissingué mine keeps on moving without a hitch as it has been for the last sort of 6 months. The other one that Dacian Gold is another stock that I'm pretty involved in at the moment, and I think is probably one of the better mid-cap plays, or moving to mid-cap. They're just starting production. They had the second quarter of production. I thought the Dacian report was reasonably good. They're probably missed a little bit on the headline number, but the underlying production trends look fairly strong, and I think their production was kind of a function of just the unavailability of some underground ore, and they're not quite to the full production underground yet, and it didn't have the stockpiles that they perhaps had in the last quarter of higher grade ore. But it seems like they're making good progress, and I'm pretty confident with these guys, and that's why I've taken a good position in this stock. And I think they're going to be gradually improving over the next 6 to 9 months, and they should be getting up toward 50,000 ounces plus a quarter, which is a really good production run rate. And I think the market will like that, and the stock will probably get re-rated above that $3 level again. So I'm going to continue to hold Dacian. It initially sort of had a fairly weak reaction to the quarterly on Monday the 15th, and then I think some analyst reports came out on Tuesday, and again it's had a nice little move toward the end of last week, closing on sort of about a 4-month high there on maybe not 4 months, a 3-month high. So potentially could head back toward this breakdown at 260, 265 in the short term, I think, and then I'm hoping for a bit of a run on the next. It's all going to come down to those production reports, but they're making good progress. Northern Star is probably one that's a little bit interesting. I know a lot of people still follow Northern Star and hold it. It's they had their numbers come out. I thought they were only okay. The Pogo's is not under their management control, but they received the financial benefits this quarter. But you can see it's almost 1,500 Australian an ounce production cost, fairly higher cost. They say they're making all the right moves there and turning it around, but that could take a while. And I'm not sure if that they've added about $1 billion in market cap since that acquisition, which is a bit of a potentially it could be an issue. It's for every seller, every buyer of an asset, there's a seller, and the Japanese Sumitomo is not necessarily stupid. So I'm not sure if it's going to be as an easy turnaround as maybe the market thinks there. Clearly, Northern Star are good operators, but you need to be a bit cautious. I know they did have issues in the past. They're one of the other mines they bought, and that they were constantly turning it around, and it never really got there, and they ended up divesting it. The name escapes me right now, but that was one of the ones they bought from Newmont or Barrick in 2014. So you just need to be a little bit cautious there. And some of their Australian operations were not super low cost as well. They were Kalgoorlie operations, 1,300 Australian is. They've changed the way they're operating now, so they've gone to a higher production base, but at higher cost, and so they're not going to have those $1,000 an ounce numbers anymore. So you need to be a little bit cautious there, and I'm not sure if the market might be still expecting them to reach these 1,050 to 1,150, and on today's number that could be a bit of a stretch on this quarter's number, but they're saying they're going to improve Pogo and turn it around. So we'll see how we go there. One of the other things I wanted to talk about was the broader gold market and the GDX. Interesting thing happened on the GDX on Thursday night Australian time. Gold price was flat on that day. GDX closed down more than 5%, I think, or about 5%. You can see here this big red candle, and a lot of that was down to a result from Goldcorp, and it was their shares fell about 20% on Thursday, and that's a story across a lot of the gold producers last week in the US. Weak results. You can see a huge candle down, stock trading at well 10-year lows, almost, or more than 10 years. Newmont, another one that's really struggling. These are the biggest, some of the biggest producers in the world. Newmont shares almost trading at 52-week lows as well, or more. And then Barrick's done all right since the merger with Randgold was announced, but still, it's not. A lot of these companies are not doing well. Their costs are increasing. They're not profitable. And I think it just shows you why the Australian gold miners have done so well in the last couple of years, that these international miners are really struggling, and the money's needs to find. If people want exposure to the gold sector, they're better off being in some of these well-run Australian companies, and that's why you're seeing companies like Northern Star move into the US and hopefully turning those assets around that some of these US and Canadian miners are struggling to maintain properly. So I guess it underlines the point that buying the GDX is probably not a good move necessarily, just because of the poor management of some of these companies in the US. And companies like Regis had another good result. Shares are up sort of 20% from the lows. And I think Evolution's numbers were okay. St. Barbara's numbers were pretty decent. So the general trend is that the US and Canadian companies are really struggling to match the Australian operating performance. So I probably had a good move back up. A lot of these stocks sort of struggling again at 200-day moving averages. So maybe there's a bit of a pause there. This was a considerable breakdown in companies like Northern Star and Regis. So I'm not sure how many more legs these rallies have. But in general, they're better than some of those US companies, and I think it shows the broader trend in the gold market of higher costs, and why I like those low cost development plays, or forecast low cost development plays like West African Resources, Cardinal Resources, and even some of the lower cost Australian development projects. These big miners are going to need these projects because their costs are increasing all the time at their existing assets. They're not profitable, and they need new projects that are of better quality than what they're depleting. So that's why I like that. I think there will be that move into exploration or M&A, and we've already seen it starting somewhat. The Barrick Randgold merge is probably not quite the same, but in general, I think there's going to be a move into these better development plays, because the companies at the top producers simply need these ounces to stay profitable, because their cost base is really increasing, and they've whether that's a function of their previous mistakes, or they're just a general increase in costs that they can't maintain their production costs. I think Goldcorp was produced at about $1,000 an ounce average cost last quarter. So projects like Cardinals, I think $700 an ounce production costs, almost 5 million ounce reserve. I think someone will buy that at some point, and they'll probably have to pay a decent amount for it, because they just don't. These explorers will know that what they have is desired, and there'll be competition for these assets. Goldfields has already put a good stake into Cardinal to sort of cement their position there, I guess, if there was any takeover activity. But that's the broader trend I'm following. Dacian's another one in that category where it potentially is a company worthy of a takeover because of their decent reserves, lower costs, and there's just simply no projects of that quality in Australia at the moment. They're the highest. They're the projects of 1,000 Australian dollars an ounce in Western Australia, with 200,000 ounce production, are pretty well sought after, and I think their Dacian Gold will probably be a good takeover candidate for some of these Australian miners looking to expand as well. Someone like St. Barbara potentially, or Saracen. So anyway, that's the broader trends in the market, and I thought that was interesting when I saw the GDX was down 5%, even though the gold price was flat to up on Thursday night Australian time. So it really shows you've got to be careful with your investments in this sector. There's a lot of poorly managed companies, and you can't just stick it in an ETF and hope for the best. I mean, you will get that diversification, that the shares might not go down a lot, but there's also a lot of poorly run companies that mean they might not go up a lot, the GDX. So I think you're better off being selective, and that's why I do some of these videos, to try and find some of those companies that are in a good position in at least the short term, and better places to put your money.